Okay, great. Thank you so much. Welcome to the webinar. Welcome, everybody. My name is Walter Peters. I'm a full-time trader. I did a PhD in psychology, and I wrote the book Naked Forex. And today, we're going to talk about 3 simple ways to find more profits. Now, I don't expect, hey, Bella, welcome. I don't expect that all of these will fit everyone watching this recording and those of you that are here live. Thank you to those of you watching the recording as well. Appreciate you having you here. Um, I know, you got to take time out of your day to do these things. And if you're like me, you kind of have to decide, what's worth it. So hopefully this is going to be one of those ones that you can take some things away and use them in your everyday trading. Now, first, what I want to say is there are many ways to approach this. And what I'm going to do is give you the easiest to implement broad-based principles that you can apply. It doesn't really matter how you trade. In other words, these are trading system independent in most cases. So that's kind of the key here. So let's talk about we'll come back to the euro pound. Right now what I want to do is I want to go to the CAD yen. All right. Now, what I have here on my chart, and this, if you haven't seen the way that I trade before, then this might come as kind of a weird thing to you, and you think, well, what is he doing? Basically, I draw these lines here, these dashed lines to remind me that the market can break through these levels, and I draw them at the support and resistance levels that I've noticed in the past. Okay, so that's really what all those things are. Now, this chart probably has a few too many on here. Uh, usually I wouldn't want, one candle to touch 2 of them. I probably could do without some of these, but you get the basic idea here. I mean, this is a 4-hour chart. CAD yen's pretty volatile, so we would expect these to be about 70 pips apart or something like that, 60, 70 pips apart in general, like this spacing. But it depends on the time frame if you're looking at weekly or daily or 4-hour or whatever. So what I want to do here is to illustrate the first one. Now the thing I like about the CAD yen is it moves around a lot. It's like the pound New Zealand or the pound yen or whatever. It's got some kick to it, right? Which is great. Now I'm going to show you very simply what we might do, and like anything that I or anyone else shows you in trading, you should definitely say, I wonder if that's true, and go test it in Forex Tester. In fact, maybe we should do that today. I'll get Forex Tester, fire up Forex Tester. Maybe we can do that. But the point is, you should never just say, oh, whatever he says is true or whatever she says is true. Really, what you want to do is you want to identify whether or not the principle that you learned in the webinar or online or wherever in a book, if that translates for you. And the way that I know, the best way I know how to do that is to use a simulator such as Forex Tester. Now, Forex Tester can be had by going to forextester.com, but you can also get a copy of it for a discount at fxjake.com/tester. Now, they will pay me a little bit, like 20 or 30 bucks if you buy it through this link, but you're going to save like 50 or 60 bucks if you use my link instead of going directly to their homepage. And I think there are other software programs that do similar things to Forex Tester, which is basically, you put in old data from the last 15 years or so into Forex Tester, and you can trade the charts as if you were back in 2007, that sort of thing. But I really like it, and I don't really know, to be honest with you, I don't know any traders that are good at this that don't use a simulator like Forex Tester. Everyone I know, like if you just come up with an idea and then go and trade it live, like usually those people just fall apart at the seams. People who do the testing, they're usually the ones that can make some money at this and be consistent. So, hey Nick, glad to have you here, buddy. So I would definitely use Forex Tester. Okay, so there's a little Forex Tester spiel. Now let's talk about. Now, having said that, you don't necessarily have to use a simulator. You could use MT4. So what I have here is my MT4 chart, and I'm just pressing the F12 key. Now this is actually quite a bullish setup here. This big giant candle and then the little candles up at the top usually means the market's going to keep going higher. But let's keep going here. And what I want to do is I want to see if we can get a good signal on the chart. Oh, there's one right there. Okay. All right. So we have one. Okay. This is a what we call a belt. Now, a belt is when the market kind of gaps, and it's generally you're going to see them on Mondays. It's quite rare to see them any other day of the week. So Mondays or Sundays, depending on where you are in the world. But when the market opens for the week, so after the weekend, that's when you get these jump and belt trades. Now, this is a belt trade. I kind of missed it. I went a little bit too fast, so I should have really entered on the high of this candle, but that doesn't matter. I can enter right now on this close. So what that means is my stop loss for this trade is going to be roughly about 27 pips, so 83.65. Okay, so I'm going to go ahead and put these levels in. Whoa, 83.65. We want that. Okay, so my stop goes down here at 83.65, right? And boom, that's down there. And my buy order is at the close of this candle, which is at 83.93. Okay, so I'm gonna go 83.93. Why does it keep doing that? I don't like that thing. 83.93 is my buy. So what I do on my charts is I always put the blue price is the entry price, the red price is the stop, and then the green price is the target. Now, not 83.65 is the stop, 83.93. So that's 28 pips if my math is correct. So what I want to see is can we get double that? Can we get 56 pips out of this sucker? The answer is yes, just. If we go to this next level up here. So we can't target this first level, but the second level up here will give me about 56 pips. So that's good. That's 2 to 1, which is great. So my target is going to be, what is it? $84.50, which I think is actually 57 pips, but whatever. 84.50 is my target. Okay, so that goes green. All right, so now the trade itself, like the signal and all that, the fact that it's a belt, that doesn't really matter to me. What I'm trying to do, hey Pat, great to have you here. What I'm trying to offer you guys is a strategy for increasing your winners. Okay, and now this is going to work in a variety of different situations, not just, a 4-hour CAD yen belt. The principle is quite a broad principle that applies to many, many different trading systems. Okay, so now let's talk about this. I've got 28 pips of risk at the moment. Now what I want to do is I want to mark the halfway point. So where is it that I would be halfway between my entry price, which is at 83.93, and then 28 pips higher, which is up here at 84.21, right? Yes, 84.21. So what I'm going to do is I'm going to mark 84.21 on here, just so we have just so many numbers on here we can't even see the price action, right? 84.21, and this is where we're going to add a position, okay? This is a new position that I'm going to jump into when the market hits 84.21. So that's a pending order, okay? So let's see what happens here. Boom. We are at 84.16. So we're almost at the point where this 84.21 order is going to kick in. And we'll put the target way up here. Whoops. way up here so it's out of the way. Like this. Okay, so let me advance the charts again so we're at where we okay. Where are we? Yeah, there's the belt. There's where I get in. There it goes up. And now, okay, so now what's happened is it's triggered my 84.21. So if let's say that I had one lot on the original position at 93, 28 pips later, I'm triggered with two lots at 84.21. Now, the astute ones out there might be saying, okay, Walter, that's cool, but now you actually have more risk on the table. So what we're going to do is we're going to go ahead and move that original position, remember, which is in blue. We're going to move the stop loss from down there, 28 pips away, to break even. So the stop loss is going to be 83.93 instead of 65. Now that doesn't, I mean, in theory, you'll hear people say that removes the risk on the original position. It doesn't actually, because you can still get gapped and slipped and all that. But as best possible, what we're trying to do is remove the risk on that position. You can still get slipped, you can still lose money, you can still get gapped because you have extra, you have that trade in the market. But what we're hoping is that in most cases, what will happen is if the market goes against us, it'll pop that one out at break even, which means, of course, we have the original position, the original positions at essentially break even, right? But this new position that was taken at 21 and that is currently at 32, so it's up 11 pips or so, 10, 11 pips. This one we can move the stop loss down to where? To 93. So the stop loss for position 1 and position 2 is now at 93. So what's our total risk, guys? Mohammed, what's our total risk? If we had 28 pips of risk on the original position and it's at break even now, it's got no risk, essentially. I mean, that's how we'll look at it. There still is risk there. There's risk of getting slipped and all that, but we'll just call it zero risk, okay? But now this next one, if I move the stop loss to 93, we got in at 21, how many pips am I risking? It's 28. Yeah, 28. So 28 plus 93 is 21. Yeah. So what that means now is I still have the same amount of risk that I had in my original position, right? But I have the added bonus of that if the market gets to 50 where my target is, then I have now 150% of the profit that I thought I was going to have. See? Yeah, so let's see what happens. We pull back. Now, did it get to 93 here? The answer is no. It got as low as 08. So it did not pop me out. It did not get stopped out. And what's the high here? No, hasn't hit my target. Still hasn't hit my target. It's been as high as 46. 54. Boom, I'm out. So now it's taken out my trade. So let's talk about what happened here. I took a trade and because I had a signal of this belt. It was a pullback. The market was going up, 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 making higher highs and higher lows. It pulled back down here, made a move up, pulled back again and gave me a belt right on a zone, which is brilliant. So I went in one position. It went halfway to my target, which was this swing high up here, right? It went halfway to my target, so I added another position and moved my first position to break even. So then when the market finally hit my target up here, I didn't have just 56 pips. I actually made 56 pips plus 28 pips. Which is 76.84, if my math is right. And I believe it is. So I made 84 pips. Remember, the risk that I had after I got that second position was still 28 pips, right? So instead of being a 2-to-1 trade or a 2R trade, is everyone familiar with R? R is just that it came from Van Tharp, and what you're doing is you're basically saying how how much did I risk on the trade versus how much did I make. If you have a 2R trade, you made twice what you risked. In this case, that's what that was. It was 28 pips of risk, and I made 56 pips, right? So it was a 2R trade. Um, but guess what? This wasn't a 2R trade because I risked 28 pips and I made 84, right? 28 pips of risk to make 84. That's extraordinary, right? That's really, really good. In fact, my handy dandy calculator here tells me that 84 divided by 28 is 3R. How about that? So I made 3R on a trade instead of 2R. Now, what happens when it pulls back and it stops me out? Well, it stops me out at negative 1R. I could have been stopped out at the beginning of the trade before I entered the second position, and I could have been stopped out after I entered the second position. That certainly is true. There's other ways to deal with that. Like what I could have done, and I know this is kind of getting into advanced stuff or whatever, but instead of just taking one position on the original signal on the belt and another position when the market went halfway to my target at 84.50, what I could have done is taken a half of a position. So I have one lot on the original trade, and then I have half a lot on my additional trade. Now, what that enables me to do is now I have a couple of different options here. What I might do is do what I did in this instance, which is just keep the stop loss 28 pips away on the second position. So the first position goes to break even, and the second position has 28 pips of risk. If it pulls back and stops me out, I lose 0.5R, right? Now, I wouldn't have made 84 pips, right? Because remember, it was half the size, so it would have been 56 plus 14, right? So it would have been 70 pips if that's right. Yeah, 56 plus 14 instead of 56 plus 28. So I would have made 70 pips, right? I would have made 70 pips instead of 84 because I had half the size. So that would have been one way to do it. So in that case, I'm still adding potential reward if the market hits my target without retracing too much, but I'm also reducing my risk. So in the first example I gave you, we had the same amount of risk once we added that position, but you could have reduced that in half by doing what I just said, which is take half the size of the second position. That's one way to do it. The other way to do it is to take half the size of the second position, but then double your stop loss. Okay? So what does that do? Now that's interesting because if we get in at 84.21 with a half a position, so 0.5 lots, right? And we leave the stop loss down at 83.93, which is sorry, not at 83.93, down here at the low, which was we got in at 93. Yeah, we got in at 93, so we got at 73.65, right? It was at 65. So I leave the stop loss down here at 83.65. What that does is a couple of things. I've now what I've done is I've now given my second position more wiggle room, okay? Instead of having 28 pips of wiggle room, it now has 56 pips of wiggle room. I can still move the stop loss on the first position to break even, right? So if it retraces against me, I get popped out of my first position because the stop loss is at 83.93. But my second position, if I keep my stop loss down there at 83.65, which was the original stop loss on the first position, I've doubled the room that I have, the wiggle room for the trade. Now that's great because guess what? I've doubled the wiggle room, so it's less likely to get stopped out. So it might stop out the first position, but it may not stop out the second position, in which case I have the consolation prize of essentially making half of what I was hoping to make You know what I mean? So, it's almost like a break even plus a little bit of, sugar or whatever. And you're like, yeah, that's great. I got a little bit of sugar, that sort of thing. Now, there's another way you can do it, and, you can split hairs as much as you want. Another way to do it would be to simply move the stop loss on the original position from 83.65 halfway up, so 14 pips up, which would put it at 79, 83.79, right? I could do that. So I'm not totally going to break even. Now, if I take that second position at 84.21, if you think about it, now I've got 0.5 R at risk on my original position, right? Because it can't go all the way down to 65 and stop me out at a full R. It can only go down to 79 and stop me out at half an R. And then if I have this second position that I started at 84.21, I bought at 84.21, if I have that stop loss all the way down there at 83.93, which was the entry price of the first position, now I still have 1 R, right? I still have a full R of risk, and yet I can still get 2.5 R if the market goes all the way to my target. So these are a couple of things that I would definitely look at doing, Gregor, Mohammed, Pat, Nick, Bella. These are things that I would definitely test. It's a trade-off between the overall R that you're going to hit and the amount of cushion or allowing the market to pull back against you that you're willing to live with, basically. So there are multiple ways to do this. You might have to go back and watch this recording because it's kind of detailed what we talked about, but I know you could probably get the basic idea. The basic idea here, this is a very simple idea, is that if by adding to your trades when they become winners, you can make your winners bigger. Most traders do the opposite. Most traders take a trade, and if it goes against them, they add to their losers. This is a bad idea. I know it sounds like I don't mean to be pedantic here, but the majority of traders find much more comfort in adding to losing trades than they do winners. It's so true. If you've been trading for 5, 6, 7, 8 years, you know this. If you've been trading for only a year or two, this might sound kind of counterintuitive. Why would I add more risk if the trade's going in my favor? The answer is because it's likely to hit your target. If the market goes halfway to your target, it might hit your target. If the market goes halfway to your stop, it's probably going to hit your stop. So what you want to do here, instead of adding to losing trades, which is the comfortable thing to do, think about adding to winners. It's a very, very easy way to bump up your average winner, okay? So have a look at that. Now, let's switch gears here. We don't have much time. I want to go to number 2. Number 2 actually just happened to me yesterday. So it's a great example. This is the Swissy. And what you'll notice here is it's the dollar Swissy 4-hour chart. Now, this is the trade that I had here. I had a sell on the Swissy at 94.46. The reason why it was 94.46 was because the low on this candle, so I'm going to mark it so you can see exactly which one I'm talking about. This candle right here. The low on that candle was 94.53, right? So 94.53, 7 pips lower than 53 is 46, and that's where I put my entry price. Now, I actually mentioned this. If you're in the private forum, I mentioned this in my update, that I suspected that the most likely thing that we would see here is that we would see the market go up a bit, probably to this red area, and then maybe reverse. But that if it did fall through this little trend line thing here, that I would want to get in and sell because this is in a downtrend and I want to sell. All right? What's interesting to me about this is that I was basically wrong. I mean, the market not only it went up, so I was right, but it went up further than I thought it might. And so the reason why this is important is because I avoided a losing trade. Okay, so the stop loss was up here at, I think it was 20. Yeah, 95.20. So stop loss was basically on this little high right here, this little candle at 95.20. So if the market had fallen through and triggered my 94.46 sell, I would have had a stop loss up here at 95.20. Now, it didn't do that, of course. It bounced here hard, went as low as 94.54, and then it went straight up, and it's gone straight up since. It's pulled back a little bit on the current 4-hour candle, but it's basically gone up. Okay? Now, I avoided a losing trade simply by waiting for the market to start going in the direction that I expected it to go, which was down. So, and this is another thing. Traders feel comfortable getting in on a retracement. Would it have felt better to me to get in when the market was forming this candle when I put my order in? Yeah, of course. It would have been a lot better for me to get in at 94.82 instead of 46, right? Save myself 36 pips by getting in at 82 and selling on this candle, right? That would have been much easier to do, and it would have tightened my stop up. 82 to 20 is only 32 pips of risk, yada, yada, yada. But the problem is, I wasn't sure that the market was going to break this trend line and start trading lower. So I wanted the market to tell me that it's ready to go. And this is a really important principle, and sometimes it takes a while to understand the power of this. It sounds really simple, but this is the way I like to look at this. Waiting for the market to tell you it is gonna go in expected direction. Waiting for the market to tell you that it's going to go in the expected direction is gold. Because every single losing trade has to start going towards my stop loss, right? Like this one did. It started going to my stop loss. Now, luckily, it went to my stop loss level before I ever got into the trade. But the only way I was able to let the market go to my stop loss, straight to my stop loss, without stopping me out, is by putting an order at a place where the market had to make a new low. It had to trade lower than this candle in order to get me into the trade. And it never did that. Instead, it went against me. It went in the other direction, and I was able to avoid a loser. So this is really powerful stuff. I'll throw in a bonus one too. If you trade like the daily or weekly charts, which is what I recommend for people who have jobs and don't want to sit around and watch the charts all day, even the 4-hour charts, that can take quite a bit of time to watch. So if you want to trade the daily or the weekly charts, test this. See how many of your losers are triggered on Fridays and Mondays. So if you're trading the daily charts, if you're trading the weekly charts, see what percentage of your trades that are losers fall on Monday and Friday. So that, in other words, the trade is taken on Monday or the trade is triggered on a Friday. Check that out. You might be surprised. Most traders are surprised. They're very surprised that they can avoid so many losing trades just by looking at that. Okay, you guys ready for the last one? And this is probably my favorite one, and it's something that I've recently kind of become better at using these data. Okay, so let me show you a couple of things here. I just want to make sure that you can see my charts here. And actually, can you see the long-short ratios on there? What do you guys see on my what do you see on the chart? Do you see my long-short ratios? Yeah, okay, cool. Thanks, Adam. Great, thanks. All right, so let's talk about this. So if you go to fxjake.com/crowd, it's going to send you to this page. All right. fxjake.com/crowd. It'll send you to the open position ratios at Awanda. Here's why this is so critical. And I'm going to give you kind of the first thing I'm looking for here is a trend. All right. Now, we know that as this webinar is being recorded, in about 7.5 hours from now, the Federal Reserve is going to release their interest rate announcement and a statement, right? And so the market's going to be looking toward that, right? Leading up to this, if we look at our charts, what we know is that the Canadian dollar has been going down. In other words, the Canadian dollar has been gaining on the U.S. dollar, right? The Aussie dollar has been gaining on the U.S. dollar leading up to this announcement. It's in a current sort of little bearish channel, but it's been going up, up, up and away recently. At least for the month of July, it has been. So leading up to this announcement, we know that there have been some trends in. And I should definitely mention. I know everyone loves to trade the euro, so I should definitely mention the euro. Also, the euro has been in. I will revise your recordings. That's funny. It's been an uptrend and it's currently consolidating here, but it's definitely been going up, 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 up. The euro has been gaining on the USD. So what I want to do is give you a framework that you can use. And I'm going to give you a couple of links here too. So I mentioned the first one, which is fxjake.com/crowd. Why would you want to go there? Well, here's in the other ones that I'm going to show you too. Number one reason is you see a trend. Okay, so that's the first step. Step two is you ask yourself, is this trend over? And number three is you see what are the other traders doing? Okay? The reason why you want to know what the other retail traders are doing, I want to stress this, retail Forex traders. We're not talking about the private funds. We're not talking about the institutions. We're talking about the retail traders. Reason why we want to know what the retail traders are doing is because they are a very good barometer of what the losers are doing. I had a friend, no names mentioned, who started a trading fund, and all he did was invited traders to come in and try and qualify for his fund and trade on demo. And once they qualified by trading on demo and making money, he would give them live accounts and they could trade for the fund for a percentage of the profits. What they didn't know was that when they were trading on demo, they were trading a live account and that it was reversing their trades. So essentially doing what brokers do. And but brokers do that with winning traders. But the point is, he knew that most of the traders would lose, and he also knew that he could make money by reversing their trades, and that's exactly what they did. And I asked him, I said, aren't you ever worried that you're gonna you're gonna have some traders that make money and they're gonna have some really big winners and some small losers? He said no. He said they always let they always let their losers run and they cut their winners short, which is of course the exact opposite. And I know it's not funny, but it's true. And so that's how he built his little empire, by basically doing that. It's crazy. So what we can do here is we see this bullish trend on the euro. So the question is it going to continue? Is the trend over or is it going to keep doing? Well, I asked myself, what are others doing? So the way I see is I go to the euro. This is the Awanda data. And you can see here on the euro, 69.58%. So basically 70% of traders are selling the euro and 30% of the traders are buying the euro. This tells me that I want to be in the little tiny group. So when you see these, this bar chart here, you want to be in the little tiny group here. So these little tiny groups here and these little tiny groups here. These are the groups of winners that win. The big groups, these are the losers. So the guys that are buying silver, those are the losers. The guys that are buying USD against the Swissy, they're the losers. The guys that are selling the euro against the pound, they're the losers. Selling the euro against the Swissy, they're losers. Selling the euro against the dollar, they're the losers. And even selling the euro against the yen, they're the losers. What I like to see here is, with gold and silver, you kind of want to see something around 75 to 80%. With the rest of them, once they hit 70, you're pretty much talking about it's a great imbalance on these, and you're going to see it at other places too. You can go to Daily FX, and actually they even put it in here for you, so you can tell you know exactly what to do. So 59% of the traders are long the dollar against the yen. That's a bearish signal. So they're actually telling you here, the crowd is going long. You want to be short. Same thing here with the euro. They're telling us that in their data, it's a little bit different to the Oanda data, but they're saying that 77% of the euro traders are selling the euro. So what does that mean? It's a bullish signal. You want to go long. You want to be in this 23% group. Same thing here. 71% of the traders are going long gold. You want to be in the 29% that are selling gold. 16% of the traders are buying S&P 500. You want to be in that little group. You don't want to be in the 84% who are trying to short a bullish market. So if you have so now remember I was talking about you want to see at least 70% or greater. So if you have something like this on the pound where it's 44%, 56%, that's nothing. That tells you nothing. That's not usable information. The only ones that are usable to me are the ones that are over 70%. So buying the Aussie and being in this little group here, buying S&P 500 being in this little group here, buying gold and being in this group, this small group here is 29%, and certainly buying the euro and being in this 23%. Does that make sense? You guys all cool with that? You understand what I'm talking about here? So the overall picture here is telling us what? It's telling us that the euro is going to keep going up. The euro is going to go up. I believe that the catalyst will be the Fed interest rate announcement and the statement that the Fed makes. I don't care what they say. I believe that when the market goes up, it consolidates, and the overwhelming majority of retail traders are selling this pattern, that this is simply an uptrend, consolidation, and it's going to keep going up. Same thing with the Aussie. I believe that the Aussie, besides the fact that it's just a simple bullish channel here, I believe that the Aussie is going to turn around, that the market's going to hit this little trend line here and break and go higher, and that the most likely news event is going to be the interest rate announcement and the Fed statement in 7 hours and 15 minutes. And so it's a really simple way to do this. Just to follow up, I believe that based on these data, that the Canadian dollar is going to fall and go lower. I believe that the Swiss franc, also the USD, is going to fall against the Swissy, even though it's come up. Maybe at this stage we could call it as some sort of trend line or something, something like that. This candle hasn't closed, so maybe this will end up being a wiki candle or something. I don't know. There's lots of different ways to see this, but the big picture here is when you see a trend on the charts, confirm that the trend is still intact by looking at the ratios. It's a brilliant way to see this. And if you don't believe me, one thing that you might do is go back, okay, and you can look at the open position ratios at Oanda versus historical price. So historical price versus open position Oanda. I'll show you this chart. Yeah. So this is a great example of what we're talking about here. And then now, this is the last technique, guys. So what you can do if you want is start typing in the charts that you want to see, and we'll have a look at those live charts right now. If there's any charts that you want to see. So right here, let me show you something. You can see right here that here what we want to do is see the big. Yeah, here we go. 73% at this point in time, which was June 28th, 2017. 70. Oh, sorry. Where's 78? It's 73. Okay, so July 1st. 73.3% of the traders were selling the euro, okay? And the euro went up, and it has gone up since. Um, this one down here was 67. We just hit 73% right here on June 28th, and the euro went up after that. So the black line is the price of the euro against the USD, and then these ratios here. You'll see the same thing when the market peaks out at the number of people who are buying. You don't really have any 70% here. Well, there haven't actually been a lot of buyers on the euro. I don't really see any. It's all going to be the down here in the orange. I mean, this is extreme stuff, guys. For recently, since May, there have been a lot of people selling the euro. This is a really good sign that we're in a trend here. Usually, it kind of ebbs and flows. See how it zigzags like this? This is a really cool sustained trend. It's kind of rare that you see them happen this long, you know? So it's pretty awesome. All right. Any charts that you guys want to see? So just to recap, I just want to be really clear. I like the idea of selling USD against the Swissy. I like the idea of buying euros against the USD. I like the idea of selling USD against the CAD. I like the idea of buying the Aussie, especially if it breaks this channel trend line thing here. So that would mean, trading above 79.50 basically. I like the idea of buying the euro pound. So this is like a euro pound channel thing here going on. I like the idea of it coming down here and bouncing off this, coming up here, bouncing off that, and breaking and going higher. In some ways, this is a quite similar chart to the Aussie. It's not as clean, but it's a similar chart to the Aussie. So I like that one too. Yep. Yeah, definitely buying euro pound, buying euro against the USD, selling USD against the CAD, selling USD against the Swiss, selling buying Aussie against the USD. All of those are the types of trades I like, and it's really because the charts tell me that we've got an uptrend, and because the traders are telling me that, also like S&P. If you can trade CFDs, I know a lot of people can't because they're in the United States, but if you have CFDs in your broker, then definitely here. Let me get a new chart. So here's the S&P right here. Okay. So here's your S&P chart on the daily. This is a very bullish chart. It's like incredibly bullish chart. And it certainly is going to collapse at some stage. It's going to fall, and it's going to fall quickly. But that's not now. That time is not now. Not when so many people keep shorting this chart. So it's pretty good. We talked about gold and silver. So here's gold. A lot of people are going long gold, and it's probably the case that it's just hit a swing point. It's going to fall. Same thing with silver. Here's your silver chart. It's come up to this inflection point where it, bounced up against these lows, Uh, a lot of people are going long silver. It's probably going to fall and go lower. That's probably what this is. This is probably the end, the peak. We've seen the high. It's probably going to go lower. Now, I'm not going to just use those data that say what people are doing, but an easy way to do this would be to put a stop loss up here at 16.78. That's my stop. And then selling below the low here at 16.15. That's the simple way to do it. 16.15. Now, where might I target? A really easy target on this sucker is right down here, where the market bounced here. That would be around 15.65. Boom, right there. See? So this is now, no, this pattern, this indecisive candle, this neutral candle, that can be a trend continuation candle. It often is, in fact. But in this case, with so many traders already piling in, going long, it's probably showing us that it's hit resistance here against these lows, and it's going to start to roll over. But again, by using remember we talked about the other principle. The other principle was waiting for the market to push through and make a new low if you're going to sell, or a new high if you're going to buy. So but I'm using both of those here. I'm using the principle of knowing that X number of traders are going long silver. So actually we can go here, and we can go to silver here. You can see, huh, wow, this is amazing. Yeah, wow. I mean, this is a huge number of traders here. 80% of traders are going long. Yeah. Wow. So if we go back here, let me show you. Silver is 80% of traders are going long, 20% are going short. Uh, so knowing that, and knowing that if the market makes a new low here, it's probably going to go lower because there aren't really any buyers left, then I can trade it all the way down to 1565. So there you go. So that would be risking 63 cents to make 60 or something. It's about a 1-to-1 trade, maybe a little bit less than a 1-to-1 trade. Great. Are there any questions about any of this stuff, guys, or is this all making sense to you? All good? Great. Thanks, Gregor. Yep, thanks, Pat. Okay, cool. Thank you so much for your time, guys. Thanks to those of you watching the recording. I wish you very happy trading, Adam. I hope you have a wonderful week, and we will see you soon. Thanks, guys. Take care.